And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. A wild week of trading in the past week in Russian stocks, energy ETFs, gold ETFs. Let's talk to three of the best in the business. Jan Van Eck, CEO of Van Eck, who runs the Van Eck Russian ETF, the symbol's RSX. Along with Matthew Bartolini, he's head of Spider America's research at State Street. And my old friend Todd Rosenbluth from CFRA Research. Matt, let me turn to you. Are you up, Matt? Can you hear you?
Yeah, I can hear you. Can you hear me?
Terrific, yes. Let me just turn to you. Maybe you can help explain this to everybody. I was talking to Jan about how his fund, the RSX, is still trading here in the United States, even though the underlying stocks themselves are not trading in Moscow. And explain to us how those valuations are determined, how you get an estimate on what the fair value of any ETF is when the underlying stocks aren't trading in their underlying country.
Yeah, I mean, some of the funds that are focused on Russian equities, they do own ADRs and GDRs, which are still traded in the secondary market. And therefore, because there's prices in the secondary market on those, ADRs and GDRs, that can filter back into the ETF to provide sort of a proxy value for what the basket of Russian securities could be. Overall, what we're seeing is that the ETF itself is serving as a secondary market price discovery tool where essentially risk can transfer. It's between willing buyers and sellers that are trading the ETF, and the market makers will price the ETF effectively on where they feel that risk can be transferred. And they're going to be using a multitude of inputs, whether it's historical correlations to different marketplaces, or really what we're seeing now is just a dramatic haircut based on some of the lack of trading in the local markets and what we've seen in the CDX market for Russian local bonds, but also from a currency perspective. So what I always say in these type of periods where you do have some dislocations is that the ETF will be serving as an efficient risk transfer tool and price discovery mechanism.
Yeah. Jan, Matt gave us a very good little explainer about what was going on there, about how the ETFs can still trade when the underlying stocks are closed. One thing that's very important here in determining prices is some of the stocks, for example, in the RSX, do trade as ADRs in London, like Gazprom, for example, which is down dramatically. So there are ways of estimating, in the case of if you have an ADR trading somewhere else, where it can work. But what's remarkable to me, Jan, is how well these ETFs work, even when you don't have an ADR trading in another country, how well they do at estimating what the ultimate fair value of these stocks are.
Yeah, I heard that point. That's absolutely correct. About 75% of RSX assets are either GDRs traded in London or ADRs traded here in the United States. So the one point I would add as well to the conversation is that it's very hard to determine what the underlying value is of the stocks, when they're not trading. And even so, the ETF may trade at a premium or discount based on traders' willingness to take risk on, because ultimately they do have to, exchange underlying shares into the ETF or not. And there are risks when the companies might get sanctioned, or whether people in that delivery chain, including custodians, don't want to take custody.
Yeah. Todd, this is a great teaching moment. You and I were talking about this, about the power of ETFs. This happened before. The Greek stock market, we were talking about this morning, was closed for weeks in, 2015? But the Greek ETFs here just kept trading without them. And it turns out that investors are pretty good at estimating the approximate price of stocks, even when they're not trading. And I think the Greek market was closed for 6 weeks.
That's right. We saw that with GREK, that's the Greek ETF you were referencing. We saw this with the Irish Spring. That happened with the Egypt ETF. And we tend to see this quite regularly. The bond market is closed, but ETFs like JNK and AGG and other fixed income ETFs will be trading throughout the whole day. So the ETF is available to be able to buy or sell based on what investors are looking to do, either to exit the portfolio, but they have to be aware of that the ETF is trading at a price that is often different than what the fair market value of those underlying securities are. ETFs have liquidity that the underlying stocks don't, but that's the great opportunity for investors to get out or get in when they want to.
It's remarkable to me to see we used to say the ETF tail wags the stock dog, essentially, at this point. But let me just move on about this. Matt, there's been some wild trading in energy ETFs in the last week. Heavy volume in the S&P Energy ETF, that's XLE, which you manage. Heavy volume in the Exploration and Production ETF, that's XOP, the big exploration and production companies. It's at a new high today. But I'm wondering if you can sort of differentiate it. The investors always want to know what's the difference. Where are the bets being made in energy right now?
Yeah, I mean, so XLE, broad-based energy sector ETF that tracks the S&P 500, market cap weighted, is going to have a heavy allocation to both Chevron and Exxon. Obviously, those firms have some pretty substantial international revenue. If we look at XOP, it's modified equal weighted. It just focuses on the oil producers. And that's going to have a little bit more of a domestic-oriented feel to it. And I think that's why initially on Thursday when the news broke, we saw really a dislocation between broad-based energy and more domestically oriented energy stocks. I mean, XOP was up on the day while XLE is down. But in both instances, we've seen heavy trading volumes increase over the last few days, but also inflows. I mean, XLE has taken over more than $500 million in the last 2 days, and we've seen XOP have inflows as well as traders really start to position for what we're likely to have as an elevated oil environment, but also elevated oil volatility environment that's just supported by broad-based uncertainty around the whole entire commodity complex.
Yeah, Jan, you're the commodity maven here. For many years, I've turned to you for your expertise in the commodity space. You run the Van Eck Oil Services ETF, that's OIH. This is Schlumberger, Halliburton. It's all near a new high. All these stocks are up 30% this year. I guess a fundamental question, how much more can these stocks move up, given that a lot of producers, Occidental on Friday, they've not announced big production increases. Everybody keeps saying, oh, they've got to increase production. They're being very conservative. That leaves you with oil prices. Can oil prices stay near $100 at this point?
Well, I think the whole commodity complex, just to take a step back, has generally been in a bear market for about 10 years because there was too much overproduction chasing China. And all these companies need to get a lot more disciplined, and you've seen that. I think OIH, so oil services companies, provide obviously services to the energy producers, and the energy producers have been very disciplined, to your point and to Matt's point. So I think we've got a lot more upside to OIH if we expect oil prices to stay high. Eventually, the majors and the upstreams will increase capacity, and OIH will be a beneficiary of that.
Yeah. Let me move on here. I'm hitting you on several subjects here, but it's energy, Russia, and really gold I want to turn to now. Matt, I want to ask you about gold. You're the gold ETF, GLD, that's the biggest one out there. I believe it was a new high, a 52-week high on Friday. Very heavy volume there. And yet, I'm kind of surprised it's not up more. I mean, we all hear about this gold's a safe haven story. This is like the greatest safe haven play potentially out there in many years. I hate to be cynical, but why isn't gold higher at this point?
Well, I mean, gold is at a 17-month high right now. So there has been upward momentum within the spot price of gold. And it's a result of, what we've seen from this, geopolitical instability, right? What's going on right now in Ukraine. And that has been a benefit to gold prices in terms of that, long-term volatility mitigation properties it has. I think in terms of, to your question, why it's not higher is, there is some sort of counteracting forces to it. If the dollar continues to strengthen, that typically is a headwind to the spot price of gold. Similarly, we still don't know what Federal Reserve policy is going to look like. We're going to get a great indication on Wednesday when Powell speaks to Congress. But if the Fed continues on, as Raphael Bostic had suggested, with a 50 basis point hike, that can be counteracted to the spot price of gold. So, in any instance like this, where there's some significant market volatility, gold would be sought after as that, potential safe haven asset to mitigate some of the volatility. But there are other macro forces at play here, and I think that just speaks to the type of volatility we're seeing, where it's impacting the commodity complex, it's impacting the dollar, policy decisions are in play. This is impacting pretty much every facet of the global capital markets.
Yeah. Jan, do you buy into that? I mean, I hate to be argumentative, but, it is the great safe haven play. You run the gold miners ETF, the GDX. You run the junior gold miners ETF, the GDXJ. And they have outperformed in the last couple of weeks. But do you think gold should be higher, or do you think we're trading fine here?
No, I liked what Matt had to say. Gold competes against real interest rates, but my point is these commodity cycles are multi-year cycles, and so just like it took 10 years to get into this bear market, we're not going to be out of it after 8 months or whatever, however you want to count it. So I think we've got a lot longer to go. And if you look at the 1970s and the 2000s, gold actually was a second half player. One of my colleagues says that. For the first 5 years of those big bull markets, gold underperformed commodities, but in the second half, it really shone. So if you think we're in a longer cycle, definitely keep your gold and add.
Yeah, that's the question. Are we in a longer cycle? Todd, where else can investors turn beyond just the GLD? Are you seeing demand elsewhere in the gold space? I'm talking about gold ETFs. Is money coming in here to this space?
Yeah, so gold ETFs and other precious metals ETFs have been extremely popular. Commodity ETFs in general are about 10% of the overall net inflows that we've seen year to date. They represent a much smaller part of the ETF pie. In addition to GLD, which Matt's team runs, which is the heavyweight within the space, it trades the most, we've seen some cheaper or lower expense ratio products, GLDM, which is also from State Street. We've seen AAAU, which is a Goldman Sachs ETF. We've seen iShares, IAU, and IAUM. These all have lower expense ratios. They're more for the buy and hold as opposed to the trading audience that's going to benefit from the liquidity that GLD has. So we've seen broad-based demand for gold ETFs. GLD has been the heavyweight, but we are seeing some of the more moderately sized and cheaper products gain ground.
So, Matt, GLD is kind of like the SPY for the gold business. It's got a higher expense ratio, but it's used by the active traders because it's liquid, like SPY is. If you actually want to be a long-term buy and hold guy, you wouldn't own SPY necessarily. You'd own something cheaper. If you want to be a long-term buy and hold gold, you wouldn't necessarily own GLD, right? I mean, it seems like you've kind of got it both ways here. You've got a high liquidity, slightly higher priced product in GLD and SPY, but you also have other products that are cheaper, not as liquid, but more long-term buy and hold vehicles. Or am I characterizing that right?
Well, no, I mean, much like SPY, GLD, they can both be held for strategic long-term asset allocation decisions. The liquidity properties can be really beneficial to large institutional buyers who are moving in size. Because when you are making those allocation decisions, liquidity can be extremely important, particularly if you're moving at a large size. But I think you're right. GLD is, no pun intended, the gold standard in terms of allocations with respect to gold in the ETF market. And, I think it's going to continue to be heavily utilized by a multitude of investors, whether you're short-term tactical because of that liquidity profile or long-term, just given its heritage in the space of being around since 2004. And I think what we've seen in the last few days sort of speaks to that credibility of GLD. As we saw volume spike, we saw a multitude of investors utilize it to make those allocation decisions. And I, sort of continue to see that as long as this volatility stays in place.
Yeah. Yeah, and I want to go back, I just revisit this Russian ETF question because I didn't get to, because we had audio questions, I didn't get your comments at the top. The Russian ETFs are trading, even though the Russian stocks are not in Moscow. Is there any issues around creations and redemptions? This seems to be a critical issue for obviously ETFs. I assume because the net asset value is frozen, it's trading at some kind of discount to the NAV. Are we able to do creation and redemptions right now? And what would make it problematic to continue trading the ETF? Are there any issues around whether or not that could continue trading?
Yeah, the ETF is open for business. I think the question is, what percentage of stocks in the ETF, and you can see them on our website every day, are sanctioned or somehow permanently untradeable? Right now, it was only the local market, and that was only 11% of the ETF, and I think we expect that market to open at some point. So, but that's the thing that we're keeping an eye on. And obviously, when index firms change what's in the index or stocks are halted, like you mentioned, those are all public announcements. Everyone knows at the same time.
Yeah. I think the important thing here, you see that list of ADRs there, that stocks like Gazprom, which I think is your biggest single holding, does trade as an ADR in London. So it's not really a complete stab in the dark. There are situations before, like the Greek stocks, where essentially they were real estimates here. Here, a good part of them are trading in London, so we do have some sense of where it is, even if that's an ADR, right? I think that's a very important point to make.
I think the real dividing line, right, is the financial companies. Some of the banks have been punished through sanctions, but the energy companies continue to do business. And frankly, Europe needs Russian oil and gas, and if they're going to use it, they need to pay for it. So as long as that continues, then these ETFs should, for the most part, operate successfully in the market.
Jan, you have been saying for years, largely by yourself, that we are about to enter a new commodity cycle. I don't know if you've ever used the word super cycle, so I'm not saying that you did. But we're certainly seeing an explosion in commodity demand. I guess the question is, at these prices, are we going to see demand destruction occur? I mean, sometime this summer, if gas prices keep going up, somebody's going to stop driving or resist, just like used car prices are under a lot of pressure right now because some people are walking away from the high prices. Is that at all a concern, or do you just see this commodity, let's say super cycle, continuing regardless of demand?
Look, there's certainly a sort of risk premium built into oil and gas prices right now. There's no doubt about that. But I think the real question, and Jeremy Grantham raised this issue of, we're near all-time highs in copper prices, and copper is a great indicator of, kind of the global economy. And my view is I am super bullish. I think that we can see, because of supply constraints through ESG and capital discipline and continued global growth, although it'll be a little bit slower, you're going to have a lot of pressure on prices going forward. And I think we'll be looking at those prices in the rearview mirror. I mean, that's the bull case. And also to buy the stocks and not the commodity futures, because the commodity companies are still trading at unbelievable valuation discounts.
Todd, I'm going to give you perhaps the last word. Maybe Matt wants to chime in on this about the teaching moment for ETFs. The naysayers used to say, wait till things really get crazy. The markets are going to go nuts, and the ETFs aren't going to be able to trade because the underlying stocks are going to freeze up. How many years have we been hearing this? Well, here's a crisis, yet another crisis, and it turns out the ETF business trades very well underneath it. What does this teach us? Again, I'm going to you, Todd. You're the ETF educator. What are we learning after all these years of people saying, wait till things get crazy, the ETF market's going to seize up?
Well, we've seen time and again that when the market gets crazy, investors turn to ETFs as the vehicle of choice. So RSX, despite the fact that it's down sharply for understandable reasons because the Russian stock market is trading significantly more than it ever did beforehand. We've seen it with high yield bond ETFs. We've seen it with emerging market equity products. ETFs become the vehicle of choice because you can get out when you want to, you can get in when you want to, unlike in other markets or other vehicles, which is why we continue to see record inflows for the ETF marketplace.
Matt, anything you want to add?
Yeah, I would agree with that. I mean, on Thursday when all the news broke, ETF volumes, they basically went, almost double to what they historically have been on a 20-day average. So liquidity rushed into that. So investors utilized and gravitated towards ETF structure to make portfolio decisions. They did not shy away from it. They're actually using it in a much more concerted fashion than they would on average on a daily basis. So ETFs are a really efficient vehicle, particularly in times of crises, and that's been proved year and year again.
Another example, another crisis, another example of ETFs acting very efficiently and in fact becoming the pricing vehicle. I don't like saying the ETF tail wags the stock dog, but in a sense, that is exactly what's happening. It's a great teaching moment, once again, about the power of ETFs. Folks, that does it for this week's ETF Edge. My thanks to Jan and Matt and Todd, all old friends of mine. We've asked Jan to stick around to chat a little bit more about the commodities market because he's the great maven on this, our ETF Edge podcast coming up. Remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.